Hi there, hope you're doing great today. And for those of you who have been following us for a while, you've probably heard us mention the concept of calculated risk many times. While investing in real estate comes with many benefits, just like with any investment, it also carries certain risks. And while one cannot fully eliminate risk, one can think through possible ways to mitigate such risks. So in today's quick video, we'll cover a few of the key risks typical in commercial real estate and how those can be commonly mitigated. As usual, our videos are for educational and entertainment purposes only and do not constitute tax, legal, or investment advice. So let's begin. Number 1 is cash flow risk. A lower than expected rental income or higher than expected expenses could quickly lead to thinner or potentially negative NOI. Having optimistic or aggressive assumptions not supported by current data can quickly lead a deal from hero to zero. That is why, as a way to potentially mitigate such risk and such variability is to have realistic assumptions about projected rent growth, vacancy, expenses, validated by third parties such as your lender, property manager, insurance broker, and boots on the ground contact. Number 2 is valuation risk. Of course, if anyone knew where markets would be, that person would likely be betting on the market or consulting hedge funds. However, to prudently evaluate an underlying investment, it's important to think through the exit strategy and what that potential projected exit valuation could be. If markets rise, that's great, you will be on the upside, but protecting the downside is one thing that we often think about. And so one way we model that in our projections is through the exit cap rate assumptions throughout the tenor of the deal, and effectively projecting that those cap rates will increase or valuation will decrease. Of course, if that doesn't happen, the upside is even bigger. Number 3, market risk. In prior videos, we discussed the importance of knowing your market, submarket, and how to quickly evaluate those and what questions to ask to get a better understanding of those. In addition, understanding demand and supply dynamics, absorption trends is just as important. Making sure that the property has adequate cushion as measured by low break-even occupancy, discussed in one of our prior videos, and adequate operating reserves is one way to mitigate that market risk or unexpected market turn risk upfront. In addition, having multiple exit strategy provides optionality and additional flexibility to pivot as needed. Number 4, economic risk. If a recession was to occur, are employers in the area recession resistant, or are the industries diversified enough? Does the property have particular tenant concentrations? Is this a one employer town? Selecting the markets that have a diverse employer base, preferably export related industries, and markets with higher median household income considered as at least $50,000 or above helps mitigate the downside of such potential economic risk. Number 5, interest rate risks. Macroeconomic, global, geopolitical factors, among many, can impact interest rate fluctuations. We saw that in the 2002-2003 period, and those interest rates can quickly change over a short period of time. Of course, we're not in the game of speculating where rates will be. As such, we'd like to lock in fixed rate debt. Not all debt providers have that option, but they would at least offer you some sort of risk mitigation tool, like a cap or a swap, to mitigate that fluctuation. Operational risk is number 6. This really pertains to the sponsor's ability to run the property, operate the property efficiently, and ultimately execute on the business plan. understanding the operator's performance track record, how they handled prior mistakes or failures, how they're structured, that understanding helps mitigate some of that risks and push you maybe in a different direction if you're not happy with what you hear. Number 7, legal risk. As the name suggests, this pertains to the risks of lawsuit or other legal matters like zoning, building code compliance, license requirements, and such. There are a number of ways to mitigate such risk. Of course, making sure you work with a very good attorney. On the structuring side, a security exchange attorney, a real estate attorney. In addition, working with a team such as a property manager who is well versed in the local and regional regulatory requirements. And last but not least, having adequate insurance, property, liability, title, that would provide some mitigation in the event of a loss and loss of income, loss of property, or any type of risk coverage. Number 8, liquidity risk. There's nothing worse than running out of money at the onset or in the middle of a deal. With that said, a lot of unexpected events could happen. How we mitigate that is making sure we have adequate reserves, operating reserves for day-to-day operations, as well as CapEx reserves for any improvements or rehab work we've planned to do, coupled with additional built-in cushion. Number 9, last but not least, is refinance and finance risk. Those working on deals in mid-2022 and even early 2023 likely remember many situations where the lender changed terms last minute or even walked away in the middle of a deal. Certainty of close is important, especially when working through so many variables and having earnest money, your own money, on the line. Usually the earnest money would apply to active investors and GPs, not necessarily to passive investors, but that is an item that active operators are considering. And so while you cannot control the lending landscape, working with a broker or lender who has a proven track record of closing deals usually helps. In addition, when evaluating investment opportunities, we do not bake in the refinance in the numbers. If that happens down the road, that's an added bonus. We don't want to rely on that or count on that. So we covered a lot today, but we hope today's quick video was helpful in outlining some of the key risks that we evaluate when analyzing commercial properties. And we hope today's video was helpful. If it was, please like, share, and subscribe, and we'll see you at the next one.